Good afternoon, everyone. I am Wakatsuki, Co-President of Nippon Paint Holdings. Thank you very much for joining us today despite your busy schedule. I will now outline the key points of our financial results for the second quarter of fiscal 2026. Please note that members of the media are also joining us today. I'll begin by addressing 2 points on slide number 2. First, regarding the revision of our full-year earnings forecast for fiscal 2026. To properly reflect the current market conditions, we have adjusted our exchange rate assumptions, shifting towards a weaker yen compared to the initial forecast in February. Specifically, the assumed rate for the US dollar has been revised from previously 150 yen to 155 yen for the second quarter and 156.8 yen for the full year. Chinese yuan from previously 21.5 yen to 23.1 yen for the full year. Second, regarding the definition of adjusted profit, we have slightly changed the treatment of PPA-related expenses and retroactively restated the figures from the prior years. We believe this change will allow us to improve the comparability with our global peers and better reflect our underlying business performance. First, page number 3. Please take a look at the long-term historical trend of second quarter performance. As we have mentioned before, we take a dual approach of organic growth and M&A, and we have steadily expanded the revenue, adjusted operating profit, and adjusted EPS with this approach. In the second quarter, even amidst uncertain business environments such as the raw material prices caused by the Middle East situation, we have maintained and expanded our profitability through measures like price pass-throughs and cost control. And the second quarter results represent the continuation of this track record. And especially for the second quarter, although there was no incremental contribution from the new M&A activity from the previous fiscal year, we have been able to sustain a strong organic growth in the adjusted operating profit. Next, page 4. Let's review the financial results for the second quarter. Revenue was 133.4 billion yen, up 19.4% year-on-year. This growth was driven by increased sales volume and improved product mix, as well as the favorable exchange rate. Adjusted operating profit stood at 94.9 billion yen, an increase of 30.4%, a significant increase year-on-year. Adjusted operating profit margin was 17.8%, an improvement of 1.5 percentage point from the previous year. Adjusted EPS was 29.4 yen, up 31.7% year-on-year. The key takeaway here is just not that we simply increased sales. Even amid the uncertain situation in the Middle East, we achieved a margin improvement by combining revenue growth with better raw material cost ratio and effective cost control. The impact of soaring raw material costs linked with the situation in the Middle East varies by region and business. While we were able to absorb these costs in the second quarter through price pass-throughs and cost reduction initiatives, the impact may become more pronounced in the second half of the year. We are not taking an optimistic view about this situation, and we will manage the operations in each region, closely monitoring the pricing, procurement, inventory, and SG&A expenses. Regarding the performance by segment, AOC, because the market shows signs of bottoming out, AOC achieved increases in both revenue and profit, driven by price hikes and to offset the raw material cost increase and increased sales volume. Japan, NIPSEA, other than China, and DGL Pacific also posted revenue and profit growth, supported by higher sales volume and product price increases and other factors. As for NIPSEA China, the surge in raw material costs exacerbated by the Middle East situations further compounded the effects of the weak real estate market and subdued consumer sentiment. Amid this challenging environment, rather than aggressively pushing for volume expansion, we prioritized sales discipline, cost efficiency, and the maintenance of the brand strength. And this approach allows us to secure a profit margin of about 15%. We believe it is crucial to maintain a management approach that safeguards profitability without relying on the assumption of an early recovery in the Chinese market. Next, I will explain on page 5 the revisions to our full-year earnings forecast for fiscal 2026. First, regarding revenue, we raised our forecast from the 1.92 trillion yen in February to 2 trillion yen, an improvement of 80 billion yen. This represents an expected year-on-year increase of 12.7%. We have also presented figures for adjusted metrics. We anticipate the full-year adjusted operating profit of 316 billion yen, an adjusted operating profit margin of 15.8%, and adjusted EPS of 95.7 yen. These figures represent a projected 13.6% increase in adjusted operating profit and 10% growth in adjusted EPS compared to the previous fiscal year. Driven by the strong performance in the first and second quarters, alongside the continued effectiveness of price pass-throughs and cost control measures, we expect to achieve record high levels of revenue and profit for the full year. At the same time, as we stated when we announced the first quarter results, we are adopting somewhat cautious assumptions for the second half of the year. China's real estate market is still in the process of recovery, and the consumer sentiment is still subdued. Furthermore, we continue to face rising raw material costs driven by the situation in the Middle East, and the uncertainty in the United States still continues. Rather than counting on market recovery, we believe by continuing to pass on cost, improving product mix, reducing cost, and controlling SG&A, we can absorb these cost increases and maintain the profitability levels for the full year that are in line with our projections. Regarding the reported figures, we maintain our operating profit forecast at 283 billion yen unchanged. This reflects the fact that the upward revision resulting from foreign exchange rate fluctuations is being offset by the one-off expenses such as M&A related costs and business transformation costs for the Dulux Group in Europe. We also project EPS at 81.5 yen, a figure that accounts for the impact of one-off expenses and effective tax rates. The forecast for annual dividend remains unchanged at 17 yen per share. We intend to continue prioritizing EPS growth from the perspective of MSV while updating the outlook for the fourth quarter onwards as necessary. Page 6 and 7. Next, I would like to outline the assumptions underlying our full-year forecast, reflecting the first half results, which were strong, and despite anticipating some adjustments in the second half of the year, we raised our adjusted operating profit forecast for Japan Dulux Group and NIPSEA business other than China. On the other hand, regarding NIPSEA China, where the real estate market and consumer sentiment still remain sluggish, we maintained our forecast for the automotive segment, but revised our initial forecast for both TUC and TUB. As for the Americas, due to the persistent economic uncertainty, we maintain the outlook for AOC as the market shows signs of bottoming up, but we still take a cautious approach for the Americas.
Page 8. Market conditions are expected to be flattish year-on-year in the second half and beyond. For Japan, in the second quarter, due to supply concern because of Middle East situation and brought forward demand, there was a temporarily strong movement, mainly for decorative. But for third quarter and beyond, we don't expect such special factor. China, automotive business is relatively strong, but TUC in the second quarter dropped markedly due to Middle East situation, but we expect market in the third quarter will recover to the first quarter level. The Americas, there's uncertainty in automotive production and housing demand. For AOC, end market demand cannot be said to have strong recovery yet. Meanwhile, the business is becoming solid through price flexibility, continued supply, and sales volume improvement. Given such market conditions, this full year forecast this time is not an exploration of good first half results, but rather based on the pursuit of profitable growth with uncertainty factored in. Next, page 9. I'll explain the outline of results of major segments. The details will be left to Q&A session, so just brief comment. First, Japan. Revenue 61.6 billion, up 17.9%. Adjusted operating profit is 8.9 billion, up 65%. For decorative, sales increase and sales brought forward of high durability product for architectural and structural products contributed, and for industrial automotive, sales volume increase contributed. For profit side, increased revenue and improved material cost ratio, SG&A ratio significantly contributed. NIPSEA China, revenue 129.1 billion, up 9.7%. Adjusted OP profit 18.7 billion, flattish year-on-year. On a yen basis, revenue increased, but TUC saw a 14% decrease in revenue in local currencies due to sluggish real estate market in China and weak consumer sentiment. TUB also decreased its revenue by 9% due to sluggish market in local currency. That said, profit margin is maintained by keeping sales channel discipline, avoiding inventory buildup, and improved cost efficiency. NIPSEA, except China, revenue 124.9 billion yen, up 26.4%. Adjusted operating profit 27.4 billion, up 53.1%. Very strong results. Growth was achieved in wide areas including Malaysia, Singapore, Thailand, Turkey, Indonesia, and India. Increased revenue, improved raw material cost ratio, and effort for rationalization led to profit increase. Dulux Group, First Pacific, revenue 73.7 billion, up 29.2%. Adjusted operating profit 10.7 billion yen, up 42.9%. Even under tough market environment, specialty coatings business share increase and small-sized acquisition and effects, big factor, contributed. Dulux Group Europe, revenue 50.1 billion yen, up 19.9%. Adjusted OP profit 5 billion, up 9.6%. The France was flattish year-on-year, and South and Central Europe showed some strong growth. But Europe as a whole is still on the path for recovery. Next, Americas. Revenue 34.9 billion yen, up 12.2%. Adjusted operating profit 3.2 billion yen, up 8.5%. For automotive, share increased through acquisition of new business. For decorative, price hike and effects contributed, but the market conditions remain tough. Lastly, AOC, revenue 59.1 billion, up 23%. Adjusted OP profit 21.5 billion yen, up 26%. Even without plus 12% coming from FX, the performance was very robust. While macro environment remains severe, profit contribution level remains high through pass-through of material cost increase on prices, sales volume increase, and sales volume growth in Americas and Europe exceeding that in Asia Pacific, leading to better regional breakdown. AOC, although some retrospective correction due to finalized PPA, profitability and cash creation capability on adjusted basis remains robust. Page 10, main topics. First, let me explain about purchase back of European automotive coatings business from Utram Group, which we announced today. In August 2021, we announced transfer of European automotive business to Utram Group, and this time we will purchase it back at about 47 million euro or about 8.5 billion yen. The closing is expected in October, within October 2026. With this deal and with Indian business purchased back in 2024, there will be no Nippon Paint Group business directly held by Utram Group. What is important about this deal is not the formality of buying it back, but we have made a judgment that the repurchase at this time is the best from MSV point of view. Under Utram umbrella, reorganization and other rehabilitation measures are progressed, and the performance recovered to some extent compared to the time of equity transfer. We judged it to be better to take integrated approach, including capital relationship, to accelerate automotive coating business globally. For this deal, we set up a special committee comprising of 3 independent directors to discuss profit and protection of minority shareholders, and from MSB perspective, the acquisition price was decided based on equity value calculation by the third party, and the BOD chairman Go has not participated in deliberation and resolution of this deal. In the first year after this deal, its impact for October-December 26 period is expected to be modest. From 2027, more recovery is expected. The size of financial impact is limited, but we believe it is a significant step from strategic point of view. Page 11, other topics. First, about Integrated Report 2026 issued in June. This year's report was planned, structured, and edited based on representative questions from investors to convey more clearly the present position vis-à-vis MSB journey and the points of argument from now on. Each section explains about thinking about these questions and specific initiatives. The report features many interesting content, including a dialogue among Co-President Wee, BOD Chair Nakamura, and myself. Please read it in your leisure time. On July 23rd, we announced reorganization of Japan Group, where Nippon Paint Surf Chemicals is to be split and integrated into Nippon Paint Automotive Coatings and Nippon Paint Industrial Coatings, effective January 1st, 2027. And we have publicized that information both internally and externally. We'll shift to a system to offer surface treatment product and coatings products, which have been provided from each subsidiary in a more integrated manner. By doing so, we will further strengthen product development and technology service, improving competitiveness and customer satisfaction. Lastly, let me report that we are awarded the Distinguished Service Encouragement Award at the 42nd Corporate Public Relations Awards. The advertising activities would like to deepen trust relationship with stakeholders and foster understanding and pride among employees for our company. In the second results, we achieved record high revenue and adjusted operating profit owing to global partner companies' continuous effort in wide areas, including material procurement, product supply, and customer service. That said, there remain some issues to note, such as raw materials, effects, and geopolitical risks. Our employees are operating with a sense of alert toward the second half. We are committed to pursue to achieve MSB as asset assembler by watching closely those risks and accumulating adjusted profit, EPS, and cash. We would like to continue to hold dear constructive engagement with investors. Thank you very much for listening.